Well, good morning, everyone. Thank you for joining us today. Jason, would you mind kicking us off real quickly and just giving an intro to yourself?
Yes, good morning. And thanks to Kamal and the Decimal team for helping to pull this together. Really excited to be here. So I am Jason Robart, co-founder and managing partner at SIA Ventures. I've been in and around the healthcare environment for most of my career, seen it from a number of different vantage points as a consultant at Mercer, as an exec at Health Dialogue in the chronic condition management business, at Blue Cross Blue Shield of Massachusetts for a number of years. And I think perhaps most relevant to this conversation, started the corporate venture group at Blue Cross of Massachusetts, Zaffer Investments, and then with some of our colleagues from Zaffer, founded SIA Ventures a couple of years ago. And at SIA, we are focused on early stage Series Seed A and some B companies in the healthcare space, with a particular focus on women and BIPOC founders. And I think we all know the data of what percentage of funding goes to women and BIPOC founders, and we're determined to do something about that, as well as focusing on solutions for that support better affordability, access, and ultimately health outcomes for traditionally underserved populations. So really excited to be here this morning.
Great, wonderful. Thank you, Jason. And thank you for kicking us off. Hello, everyone. I'm Kamal Jathwani. I'm the CEO and co-founder of Decimal.health. I started Decimal.health 2.5 years ago with the idea of helping digital health companies, specifically with their go-to-market strategies and commercialization efforts. In the last 2.5 years, we've worked with over 65 companies, most of them as startups, and a lot of companies and a lot of good, healthy overlap in our clients with SIA Ventures. So Jason and I got talking several months ago about what seems to be coming up as a problematic period for fundraising for startups, and whether that was actually real and whether there was any basis behind it. We obviously did not have the wonderful Rock Health report back then, and so we were postulating that this might be an issue, and that companies need to be working differently to be able to address their functioning during this period and then after, because once this is over, presumably, there will be money to be had, and that companies will be reviewed and judged differently than they are today. But I feel like a lot of our founders, especially a lot of our clients, have been hearing that and have been, sort of getting mixed signals about what that actually means. So this webinar really is to address that and really think about, what is actually happening, and is the funding winter real? Is it coming? We have Megan from Rock Health, who's going to talk a little bit about that and give us actual data to back up what we think are just hypotheses that we were all worried about. We then have Jason, who will talk a little bit about his perspective about this as a VC and what he's seeing from a funding perspective, both from the perspective of going to LPs and talking about this, as well as discussing with founders. And then we have two really amazing founders and entrepreneurs here with us, one of who actually went through this period pretty well and got through a pretty oversubscribed round, recently closed one. And the other founder who's about to get going in this really difficult, challenging time. And he's raring to go and really well prepared. And we want to learn a little bit more about from Harsh what he did well and what other founders can learn from that. And then from Nate, how he plans to address the market and what maybe some of his real concerns might be as he's going through this, so we can sort of commiserate with some of the tips that he's been receiving and the ways in which he's been preparing for this. So that's sort of what we're hoping to cover in the next 50 to 55 minutes. Without further ado, I will get the content started and hand it over to Megan to give a really quick intro and talk a little bit about the Rock Health report that came out recently.
Awesome.
Thank you.
Thanks, Kamal. Thanks so much for having me. I'm going to dig into the data. I think your hypotheses have been proven out by it, so won't kind of we'll just top line with that. I think though that data is no substitute for lived experience, right? So really excited to be part of this conversation, just to also hear what your perspectives have been as founders, and then also Jason as an investor. So I am Megan Zweig. My pronouns are she, her. I work at Rock Health. I'm the chief operating officer there. As many of you may already know, part of what Rock Health does is create thought leadership and data-driven research to better understand the digital health marketplace, including how venture funding is flowing and also what exit activity looks like. So if you're ever interested, we publish these reports on a quarterly cadence, and those are available on our website. If you want to know more, feel free to chat me. My email is just megan@rockhealth.com. I'm gonna breeze through these slides quickly, but we'll certainly share more in follow up. So as Kamal mentioned, we have seen a really significant dip in funding across 2022, and I would say especially in Q3 of 2022, the quarter that just closed. This is, of course, in relation to 2021. So if you take a look at this graph, the trend line is pretty clear. Things have been going up, 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 up. And that's in terms of both the number of dollars invested in US-based digital health companies. That's what this graph is showing, and that's the bright green bar. So in 2021, for instance, when we were kind of at peak market, peak understanding of the opportunity that digital health allows for in the context of a pandemic, you had nearly $30 billion invested in digital health companies, and that was across 736 deals. So that's the deal number is what you see with those dark green bars. Big slowdown this year. So year to date means through Q3 in this graph, just over $12.6 billion invested in US-based digital health startups. So that's a really big slowdown. We're pretty much in line with what we were seeing in 2020. One thing we asked is, where are the deals going, right? We actually think it's a few things. One is some of those deals may have been pulled early into 2021. When entrepreneurs, founders saw the fundraising environment, they may have thought, hey, it seems like there's a lot of capital available. There's a lot of momentum on the investor side. Let's go ahead and raise a little earlier than we would have otherwise. So that's kind of one way that funding may have been pulled earlier into 2021. The second reason I think for these lower numbers is there probably are a lot of deals being raised that aren't being publicly announced. Those might be down rounds. Those might be round extensions. That might be the raising of venture debt. So companies recognizing that the landscape isn't the same as it was last year, but still trying to figure out creative ways to maintain the cash runway that they're going to need to continue a healthy growth trajectory. The third possible reason is the deals aren't happening. And I will say that, valuations were a good deal higher last year. Especially when you're thinking about a Series A, Series B company raising on a high valuation, that's going to be a growth trajectory that is just going to be more challenging to maintain this year in the current economic environment. So I think in some cases, founders are really challenged to figure out, how do we maintain a proper pace, and how do we kind of reset to make sure that we are thinking more about this unit economic mindset as opposed to growth at all costs. Just to flow through a few more slides, what this one is showing is kind of the breakdown of the portion of deals across different rounds. So the bright green is showing the portion of deals that were seed stage, the dark green is Series A, the blue is Series B, so on and so forth. I just want to point out one thing on this slide, which is that the year to date, again, through Q3 2022, in that top bar, is showing that there was actually an expansion of the portion of seed and Series A deals and a contraction of Series B deals and later. This was a really stark finding in our data, showing that when it came to early stage deals, we actually saw a pretty consistent volume of deals. The average deal size was pretty consistent to what we've seen in the past. Where that contraction really happened was in terms of mega deals. So those deals over $100 million that we saw dozens of those last year. We've seen just a handful this year. So again, kind of tougher at those later stages, especially since we saw some investors that came into the market last year, like private equity, pulling back pretty hard from the market this year. I also wanted to just talk a little bit about exits, right? That's, there are a few different sides to this equation. Exits is certainly one of them. What these bars are showing is the number of acquisitions of US-based digital health companies on a monthly basis, and the different colors represent the years. So blue is 2020, the dark green is 2021, and then the bright green is this year. What you can tell is that the bright green bar is significantly lower than the activity that we saw last year. I think what's to come is actually open to conversation. So excited to hear my fellow panelists' perspective. But I think with some of the momentum that we're seeing, for instance, with Amazon intending to or showing their intent to buy One Medical, CVS doing the same with Signify Health, it's clear that some of these big companies are looking to acquisition to continue their product roadmap when it comes to kind of tech-enabled services and digital health acquisitions. And I think with some of these depressed prices, we may actually see some mergers among digital health companies and continued acquisition activity, even though we still aren't seeing the same level of activity that we saw last year. And finally, just to land on some public market data, because of course there's exit paths via M&A, there's exit paths via the public market. The public market has really closed this year. Last year, we saw a bunch of companies go public. We've only seen one this year so far in terms of digital health companies. That was Akili Therapeutics. They went public via SPAC, also a vehicle that has become kind of less popular than what we were seeing last year in terms of activity. In terms of the performance of these companies, at Rock Health, we've created what we call our digital health index, which is essentially all the companies on the public markets, traded on the public markets that are digital health. Their performance is what you see with that dark green bar. So they are trending as of Q3 slightly lower than some of the comparison points, the S&P 500, the S&P 500 healthcare. I think part of that is, these are newer models, admittedly. There aren't that many of these companies. And so I think the market is still trying to figure out, how do we price these? We thought digital health might be SaaS. Now it's a lot of SaaS plus services. So how do we think about the value and the growth trajectory? But still wanted to share, because certainly, as we are all feeling, as big companies are feeling, as smaller companies are feeling, we're just in a really different and tougher economic environment than we were 12 months ago. So that's a data-driven take, but excited to be in conversation with all of you. So I'll pass it back to you, Kamal. Thanks.
Thank you, Megan. I've read the report and I've seen some of the slides, but having you walk through it definitely adds a lot of color to it. So thank you for doing that for us. Quickly turning it over to Jason, would love your sort of feedback and commentary on what you're hearing here, and sort of maybe giving us a little bit of color on the lived experience side of these numbers and graphs.
Lived might be a strong word to go through. Well, first of all, Megan, thank you. I think that's it's really powerful data. I think back to that first slide, and to think that within a decade, right, digital health funding went from 1.6 billion to roughly 30 billion within a decade. That's just remarkable. And sure, some of that was overhyped and overpriced, but it does tell us is indicative of the growth in the sector, and the promise that investors like me and others on the call and participating see in the promise of digital health, and we really do think and continue to be as bullish as we've always been on the promise, again, to improve access, affordability, and outcomes for everyone. So some great data there. Kamal, going to your point of how are we looking at this at SIA, and it's also great, Megan, to see the data on seed and Series A companies continuing to be able to raise capital. As we look at it, we are looking at how do we think about our existing portfolio companies versus potential new investments. And we had our annual meeting with our LPs about a month ago and talked with our LPs about this balance of new investments and should we take a different look at our reserve strategy going forward, and perhaps hold a little bit more in reserves for some of our existing portfolio companies as they deploy some of those creative financing rounds, Megan, that you talked about, the bridges, the extensions, et cetera, so that they're not actually forced to go out into a slightly depressed market with slightly depressed valuations and strike deals that are not on terms that they would otherwise normally be excited to take. So, we do think for the right companies, those companies that frankly are showing engagement and are showing outcomes, right? At the end of the day, that's what matters. Can you engage a patient, and are you delivering better health outcomes, better cost outcomes for the companies that you're working with? For those companies, the dollars are there. I think it's not. I don't think there's necessarily a reduction in the available capital. There's a delay in the deployment of capital, but as we know, at the end of the day, investors have to deploy the capital. LPs will insist that they actually put that capital to work. And we think, those companies that really are delivering engagement and outcomes, will continue to be able to raise capital. Just might take a little bit longer, and might have to be a little bit more creative in how to do that.
So, Jason, before I move on to Harsh and Nate, another question I've often heard entrepreneurs ask is, we're in a pretty difficult funding time, or we expect to be in that. We're expected to cut burn rate. We're expected to reduce, all of our sort of discretionary expenses, et cetera. We expected to have a longer runway, and yet the expectations of success or outcomes or ARR, et cetera, are through the roof. So how do you reconcile that? How do you make the car go further with less gas in the tank?
Yeah, that's why I'm on this side of the table and not on Harsh and Nate's side of the table, because I don't have to figure the answer out to that. No, it's a great question, and we are in that same boat of having conversations with our portfolio companies around really let's think judiciously about burn. Cutting burn, at all costs is not a solution, right? I forget who it was who made the comment, you can't cut your way to growth. But we need to be prudent, and we need to think about what are those things that are must-haves, that are nice to haves, and things that we don't really need. So we've been encouraging our portfolio companies to think about that. We've encouraged our portfolio companies to think about the right balance between build, borrow, and buy. As they think about solutions, think about technology going forward. Are there opportunities that you might have decided you wanted to build a platform, you wanted it to be homegrown? Well, let's think, is there an opportunity to borrow from another company? Is there an opportunity to partner with, and we've tried to have some of that conversation, and I think Harsh and Nate are two examples of this, where we're looking across our entire portfolio to say, is there a solution that Nate might have that would be valuable for Harsh, or valuable for Kevin at Hurdle, or Raj at MyMeds? And how do we do some capability chaining in the near term that would be both productive from a growth perspective and product development perspective, but also help maintain or control burn going forward? But yeah, it's that striking that right balance is really difficult. The one piece of advice I would offer to any founder right now is stay close to your investors, and alignment, and have this conversation about how do we balance burn and continue to invest for growth, and what are the associated trade-offs. And just make sure that you're aligned on what those trade-offs are, and then you can get to a decision that hopefully will be in the best interest of the company.
Very helpful. Thank you, Jason. turning over, Harsh, I'll go to you first, and if you don't mind, a quick intro about you, about Moving Analytics, and then maybe just talk through the round you just raised and what your experience was there.
Sure. Thanks a lot for the opportunity. And it was amazing to see the data because I think a lot of it mirrored with our experience as well. And some of the experiences I've seen from my fellow CEO colleagues in the space. So for the benefit of the audience, I'm Harsh Patsangam, CEO of Moving Analytics. Our mission as a company is to empower every individual to live a life free of cardiovascular disease. Cardiovascular disease is the number one cause of death, number one source of preventable direct and indirect costs. But kind of a shocking truth, but a good truth is that a large part of it is preventable if you can enable context-based behavior management. And so we've basically created evidence-based programs that are backed by multiple clinical trials, showing that we can get people to adopt healthy lifestyles and therefore reduce their risk of cardiovascular disease. And our USP has really been the data and the evidence we've been able to generate that shows that this is not snake oil. It's something that really works in different populations. And a lot of our focus now is in particularly post-acute populations, where if someone has a heart attack or heart surgery, we put them through a evidence-based clinical therapy to ensure they don't get a second heart attack or heart surgery. So with respect to fundraising, what we were very blessed to be able to raise a $20 million round, Series A. And Jason was the lead who helped us set the terms and get the round going. We originally set out, honestly, I think to raise somewhere around 13 to 14 million, and it ended up being oversubscribed as part of this. So as I think back to what I think was why we were oversubscribed, I think maybe a little bit of market timing. So we were just ahead of sort of the current situation we're in right now, where capital is a little scarce, and we felt that by raising early, we could essentially, I don't want to say time the market, but like more basically take advantage of a favorable market terms for us. In order to get the capital, we need to execute really well and potentially even wait out down cycles as part of it. That's one piece. But I think fundamentally, what I think worked for us as a business was that we took the time and effort to really work with one or two customers to generate data and outcomes showing that it actually does, that our service actually does improve patient lives, reduce cost of care and readmissions, and provide a strong economic ROI. So we took the time and effort to build that statistically significant data, which has now led to a large number of contracts, some of which will come out in the press in a couple of weeks, based on strong fundamentals. And I think when we partnered with the right investors like Jason, who are like past masters in this industry and really understand that foundation is important if you want to build a long-term sustainable business, that really brought on like really, I would say, world-class investors onto our team to get this process going. And so, I'm not the this is weird for a CEO to say, I'm not the best salesman in our company. But I think what we are really good at is really producing data and substance behind what we produce. And I think in that sense, partnering with the right investors who believe in that really helped us. And in addition to Jason, we also have Phillips on our board and our investment cap table. So really these strong industry players who believe in the solution. And I would say, sort of just thinking back, and what I would advise anyone is to find that right partner who's a suitable fit for your business. And it can vary depending on the company you're in. And so you really want to find the people who believe in you and also have the expertise to take it to the next level as well. I'll pause here, but happy to answer any questions or any follow-up points as well. It's part of it.
Sounds good, Harsh. I'll come back to you after we've heard Nate, but I have a couple of follow-ups. And Nate, I'll turn it over to you. Before I let you go, I just wanted to let everyone know we do have the ability to take audience questions. So if you do have any questions, there's a chat function. You can just send those questions to us, and we'll try to fit them into the hour. Anyway, with that, Nate, quick intro and maybe talk a little bit about your experience as you're starting to gear up for the race.
Sure. Thanks, Kamal. Yeah, Nathan Pelger. So I'm the co-founder and CEO of Decimal.health. We are a value-based care enablement company that works with health plans, MCOs, and providers that care for underserved communities and help them transition to value-based models of care delivery and reimbursement through SaaS and services. Our mission and our thesis is that for every dollar that goes in the top of the funnel, particularly in Medicaid, roughly 60 to 70 cents of that is actually utilized for medical purposes. A lot of it is, lost in administrative and other inefficiencies in the system that we try to solve with our technology platform and some of our care management resources. Our experience today, and Megan touched on this, we were gearing up to raise our Series A at the beginning of the summer. We saw sort of market conditions changing, and in conversation with some of our lead investors, of which Jason and Saya are one, we decided to do a seed extension. So we raised some capital. We didn't really publicize it, but are gearing up to now raise our Series A in the next couple of months. And a couple of things that I think are in the back of my mind, and I try to put at the forefront as we start the process is, we as CEOs, contradictory to what Har says, I am the best salesperson in our company. I try to maintain relationships with the investors that we think would be a good fit for us, whether it's today or tomorrow. So even though we're not actively raising, I'm still talking to folks about what we're doing. And I try to set, realistic goals for where we want to be in a month, 2 months, a quarter, and circle back with those investors and say, look, we've actually done it. We've shown the progress that we said we'd show. And then also inform them to make the decision easy, right? As we're starting to gear up, raising the right amount in a way that's judicious for not only our existing shareholders, but the employees and founders, is something that's front of mind. So it is a trade-off of, hey, we could grow, $5 million, $10 million next year if we raise this amount, or we could grow a little bit less and focus on value and profitability if we raise this amount. I think presenting that to the investors and helping them understand why you're trying to raise now, what the value is, what you've done, just makes the conversation easier. We are expecting that it's going to take longer, just diligence phases. Understanding our business is going to take probably 5 to 6 months, whereas historically it could get done in 3 to 4 months. That being said, I think we're in an industry and a space within an industry that is getting a lot of tailwinds. So a lot of folks are trying to figure out how to address Medicaid, how to address community-based care, how to influence clinical decision making both inside the clinic and in the community, and that's exactly what we do. So I guess in summary, just kind of packaging everything up so that investors really understand what you've done, where you're going, and the likelihood that you're going to get there with the capital that you're asking for is really our approach to getting them on board as we start to kick this process off.
Nate, have you done or do you intend on doing anything differently given the funding environment now that you probably would not have if things would have been looking like 2021 in terms of
Yeah, that's a good question, Kamal. So this process is going to be much more structured. We are going to have very sort of stage gated approaches to the investors we're working with, right? So early on, we'll show you what we've done, we'll tell you about the company. And as your continued interest, I will spend more time and the team will spend more time kind of having those conversations, because those diligence timeframes are going to be stretched so much longer. We don't want to get bogged down in fundraising and off the grid for 6 months with that solely. So we want to kind of create a funnel where folks have a good understanding of what we're doing, where we're trying to go, what the round is about before our team is spending hours and hours and hours on the phone, kind of talking them through our model and where we're building to. So I think, historically, when we raised our seed, it was more, hey, one-off conversations. We've got a couple of questions, we'll talk on the phone. We'll still do that. But again, we want to make sure that our investors are the right ones, that they understand us and we understand them before we allocate a lot of time to getting them over the finish line early on.
That's great. Jason, question back to you about how has your investment thesis changed, or are you approaching Fund 1 differently given what you're anticipating over the next 3 to 6 months in terms of how you're making newer investments and how supporting your portfolio companies? What has changed for you guys as a fund?
So everything and nothing. And what I mean by that is obviously, we are continuing to meet with prospective portfolio companies. Obviously, we're probably getting a little bit digging a little deeper with our existing portfolio companies, and whether that is in helping to really think through product development, helping to leverage our network for introductions and supporting the sales processes with our existing portfolio companies, and as in both cases with Moving and with Clinifi, really rolling up our sleeves in the fundraising process. That we view ourselves as an extension of Harsh or Nate's teams as it relates to both the ongoing support of the company as well as in the fundraising effort. So we're probably doing a little bit more of that and spending a little bit more time there. As I mentioned at the outset, one of the things we have done is to really take another hard look at our fund construction model and what are we holding in reserves. So we have space right now for probably 2 to 4 additional investments out of Fund 1. My guess is we're going to be on the low side of that, so that we can continue to ensure we have some dry powder for existing portfolio companies who might be in that extension period or bridge period as they continue to demonstrate value and perhaps not to try to market time, but to perhaps enjoy a little bit easier effort to raise capital. So from that perspective, yeah, we're probably digging into the fundamentals of support for our portfolio companies a little bit more, but our overall thesis, our overall bullishness on the space hasn't changed at all.
Thank you for that, Jason. That makes a lot of sense. On that note, actually, we do have a question from one of the attendees, and Megan, this one is for you. Could the declining trend in funding in 2022 just be base effect? 2021 was not normal because we had 4x deal growth rate than 2020. Maybe it's just normalizing. Have you guys considered that?
Yeah, it's such a good question. And I would say, so my perspective, 2021 was an anomaly. I don't think any of us expected that this year would match 2021 in terms of the pace and the amount of funding. And people felt like it was bubbly. Like we wrote a piece months back that was like, is digital health in a bubble? Is it too frothy? We're in a very different place than we were then. And so definitely some froth last year. In terms of your question of like, maybe it's not winter, it's just normalizing. I think it's winter in some places and it's not in others. And I think the factors that depends on, I think it's more wintry for companies that raised on high valuations last year that are later stage. The data showing us that there is the exit paths that those companies may have expected to still be open are not quite as open as they were last year. There's not quite as much capital to raise, particularly at an even higher valuation than what those companies raised at last year, because the growth trajectory is just tougher to keep up in this environment. This environment isn't just something that's being felt by startups, it's being felt by enterprises. A lot of hospitals are reporting losses. As of Q3, health systems particularly are really, really pinched when it comes to margin, when you think about labor shortages and the costs that those are driving up. And it's being felt by other types of companies as well. I just bring up health systems because I think it's particularly pervasive for those, or particularly acute for those customers and buyers. So I think, again, for companies that are later stage, it's going to feel more wintry. If you're an earlier stage company, that's raising their seed in Series A on good terms, that have investors that they trust, that are raising again on a valuation that really matches to the growth trajectory that they've mapped out, like what Harsh and Nate are speaking to. It's not going to feel that wintry. But I think winter is kind of the right the right term to consider, because we're seeing some really, really tough decisions play out right now with some of those later stage companies. I mean, we're all hearing about the layoffs, and kind of, maybe we thought those layoffs were a proactive way to get to a healthier unit economics. And we're seeing more and more of those, and it's not just a signal of returning to a healthy growth. It's like, oh, are some of these companies going to be in a bit of trouble? And again, have to think about finding capital, have to think about an earlier exit path through M&A that maybe they weren't considering before, or potentially a worse outcome. So I don't want to downplay some of those negative consequences, because I think they're really being felt by some of those founders and particularly staff right now. But I think there are also parts of the market that are going to feel really, really healthy, because we all know that we're at a time when whether it's pharma, whether it's health systems, whether it's health plans, they are all thinking about how they integrate these innovations into how they do business. They're also well aware that, as I mentioned, Amazon is acquiring One Medical, and what are the implications on care delivery and kind of new entrants coming into the space and starting to disrupt some of the channels that these organizations rely on for their businesses. So again, like I feel like I'm in business school again, where I'm like, the answer is it depends. But it really does depend on some of these factors. Yeah.
That's a really, really good point. And I think I'm going to combine that with, the idea that we're going to ask companies to do more with less. And at the same time, I think, Megan, one of the things you're saying, which is really interesting, is this is not just facing startups, but it's also facing the customers that these startups are going to go sell to, right? So you're going to see hospitals getting, layoffs and contracting. You're going to see pharma companies. You're going to see other parts of the ecosystem that are going to start to contract or start to face some of these issues as well. That potentially changes even, how startups will perform, whether they raise money or not, or even after raising money. So to that, then Harsh, I want to go back to you. Is your use of funds going to change given what's happening and how you go through and actually deploy and operate your company, given what's coming up? Or are you stable on course and continuing the way you had planned to before all this happened?
Yeah, great question. I think so. Let me kind of go back a little bit to the fundamentals, right? Like, people aren't having fewer heart attacks because we're in the middle of a digital health winter. So, like, we have 3 to 4 million people every year who have some sort of condition that can qualify them for our service. If anything, are having more heart attacks, I would say, with the stress that's inducing. So the second part, I think, is to Megan's point about payers or providers also lowering their staff footprint, right? Like, I think what we're seeing there is a little interesting tailwind for us, in that we're able to go to a provider and say, if you're lowering your staff, we can actually take that responsibility of managing those post-acute patients for you. And it's, you get to get the same benefits of a higher quality of care. By the way, he has evidence to show it. And obviously, we can work together in partnership with you to ensure you have no loss and continue your service. So I think there's an opportunity there for new business to come up for startups. Like, you as an entrepreneur, you're taught to see the glass half full and more than half empty. So so really, there's an opportunity for leveraging that gap for your business's benefit and taking that process going forward. So so all that is to say that, as far as we are concerned, we still think there's an amazing opportunity of an underserved market where 90% of people after a heart attack don't get anything, and we want to serve that, right? Like, and there's cost savings to be made there, quality of life outcomes improved there, and so we remain bullish. And that has not changed because we're in the middle of a funding winter, right? So as part of this, but a part B to that is, I think we're trying to enforce good habits in our business today by really building a data-driven culture to ensure that when we are delivering care at the cost we promised, or at the quality that we promise, and internally ensuring that every dollar we spend is spent towards one of a couple of things, either growing patient volumes, or basically making sure our margins are improving, or our bottom line profitability is improving, with a view towards building a sustainable business that is profitable in 2 to 3 years' time, right? Like, as part of it. So we're trying to be a really good business first, right? And then the fundraising is about growth and expansion, and really taking it to places that we wouldn't have been able to take fast enough if we were just growing organically. So and in that sense, we're trying to balance this tremendous opportunity in front of us with the need to be a really fundamentally good business and the discipline that goes with that. And thus be an example for when we go out fundraising next time around. And I think Nate had a really important point before, which is I think one of the things that really worked with our fundraising is we had the people who knew us and invested in us, like they didn't meet us for the first time last year. Like we built relationships, worked with them actively, kept them updated regularly over a period of 2 years. And they saw us make that traction, make those moves very consciously, and therefore had more faith in us to trust their capital with us. So I think it's all those things that you have to play when you're investing. Hopefully that answered somewhat that what the question is and how the balance is. Yeah,
it does, and I want to ask the same question, Nate, to you, which is, as you're going out and fundraising and as you're thinking about, use of funds and what you're going to use the money for, is it looking different, or are you planning to do it differently than you would have otherwise?
Yeah, and my response will echo a lot of what Harsh just mentioned. So, I said we're raising our Series A now. We actually don't need that capital for a while, right? So we're raising early. And again, echoing what Harsh said, that's because we're thinking about, trying not to conflate the capital markets with the need for our business services, right? And we know specifically in what we do with Medicaid, some of the COVID relief stuff that the plans have had, redetermination is going to be a big deal for them in the next year. So we want to be positioned to support, patient engagement, member engagement, because of this big challenge that the plans are going to face. And to do that successfully and to grow into that, we need the capital. So, without that business driver, I don't know that we would be pulling the capital raise up so much. We would probably be waiting to see where the markets are going to get a little bit more clarity. So that's one thing. Yes, it has influenced the timing. And Megan mentioned this at the outset. It's also influenced how we're thinking about the raise, and we are exploring different types of structures that may not be as dilutive if valuations continue to be squeezed for the near term. And then just the funding amount, right? If we don't need to raise the biggest Series A, we just need to raise a Series A to show that we can scale with the Series B. So all of these considerations, I think, are from the founder side, much more granular than they probably used to be last year, right? It's like, let's just go raise as much as we can at the highest valuation we can, and then we'll figure out the rest later. Now I think we're trying to be a lot more thoughtful on why are we doing it? How are we doing it? What are we doing it? And all of those questions are being answered much differently this time around than they were for our last raise.
Yeah. We have another question, and I think Megan, again, might be one for you. When do you think this winter will end, and what are you anticipating on the other side?
Oh gosh, I'm like, I don't have a crystal ball.
I know. Can you look into your crystal ball, please?
Yeah. I so I don't know. I'll preface it with I don't know. But a few thoughts. I mean, again, I think it depends like which stage of winter you're in. I think that Harsh made an incredibly important point, which is like the mechanics of or kind of what's happening with investing, and even what's happening in terms of some of the economics of other larger healthcare companies, like doesn't displace the very real needs that healthcare has, and the opportunity that we at Rock Health believe digital health solutions have to help solve those things. So when you consider things like labor shortages, how do digital tools help extend those care teams? How do they help them focus on top of license activities? How do things like, AI, ML sometimes take the place of something manual, like a manual review of patients that someone might be doing right now, and help them proactively identify, what's going on with a patient, what's the right intervention and next best step. So we still have a lot of faith in this market, and we continue to invest in this market because we think that there are very real business opportunities and very real opportunities to impact the outcomes that we all care about. Those are patient outcomes, those are economic outcomes, and those are efficiency outcomes that transform the lives of providers that have had a really rough few years, as we know. So I want to preface my answer with that. That said, we're hearing things like, and I think Jason, you may have heard this on the enterprise side too, but hearing things from startups like, hey, we actually capital was so available for a while that we would subsidize some of the upfront costs of implementations when we were running pilots with some of our enterprise partners. That's not a conversation that we're willing to have anymore because we just don't have that same faith that we have the cash runway or the availability of cash. And maybe that's a good thing, because maybe that means that it forces important partnership conversations earlier about what are the economics of the model, and is that going to be sustainable for both parties in the longer term. So I don't think that we're going to return to the kind of capital rich environment that we had last year for a while. But to Jason's earlier point, there is still more, what's considered dry powder capital that's been raised by investors from their LPs. Like, that amount of money is more than it's ever been, and that money is going to need to be deployed. So even though I think there's going to be a flight to quality, there's going to be, I would say, like, more conservative diligence. I've heard this on the investor side as well as the enterprise side. So when you think about acquisition teams, for example, kind of your corp dev teams, they're just taking a little bit longer to think about which investments they want to make, who they want to partner with, who they may ultimately want to acquire. And so I think it's going to slow some activity down a bit. But ultimately, I think that, we are going to see those companies that are realizing value that hits on the top priorities of buyers still have an incredible path ahead of them. I don't know if anybody else on the call has more of a crystal ball than me or is willing to share that, but that's kind of my almost non-answer for now.
I
If Rock Health doesn't have an answer to that, who am I to provide an answer to that question? The one thing I would add, though, I think is, we are experiencing a correction, and not in the sort of traditional market correction manner, but really a correction of expectations. Again, you go back from 1.6 billion 9 years ago to 30 billion last year. Really 15x growth, right? How does that happen? And the expectation of VCs, of LPs, of founders that you were going to create make a quick buck in a way that wasn't the traditional 5 to 7 years of an investment period for a fund and a 10-year total time frame for a particular fund. We got to get back to those basics. And one of the things that we really admire about what Harsh and Nate are doing in their respective organizations is this notion of sort of renewed being disciplined and being very deliberate in what the companies are doing, and not not chasing revenue, not chasing funding, but being really thoughtful and deliberate about the basic business fundamentals. We think those are the companies that will succeed, that have always had access to capital, and I would argue are always going to have access to capital in a perhaps more normalized manner.
Great. Quick reminder, if you want another question in the Q&A tab should be open still, and we could probably take another question from the audience. And while we wait for that, what I want to do is sort of a final round of comments. We have about 9 minutes left. And maybe Jason, I'll start with you and then go around to Harsh, Nate, and then Megan, end with you on this question. But the question is, what are your sort of top 1 or 2 absolutely important tips to a founder entrepreneur that's going out to raise money today? Jason?
It's things I've talked about before, and I think both Harsh and Nate have echoed. Just make sure you're really aligned with your investors, of the vision for the company, the value proposition for the company, and what appropriate milestones there are for the company over the next 12, 18, 24 months. That is critically important for I think for entrepreneurs right now. The second thing I would say, I'm going to give you three. The second is to some extent, stick to your knitting. You know, here's what you do really well. Do that really well. But at the same time, don't undersell the value of your solution. Some of the things that, again, with both Moving Analytics and Clinifi that are really great. You know, Harsh talks about the ability to help cardiac patients not have another event. What Harsh hasn't said is that the patients that are using their solution are also seeing a reduction in diabetes rates, are also seeing a reduction in hypertension rates. And if we think about those things that really matter to providers, those things that really matter to payers, you know, you've just hit on three of those chronic conditions that are really important for providers and patients. You know, Nate's solution, yes, helping providers get to and succeed in a value-based environment, but also providing that last mile of connecting. How do we ensure that Jason doesn't have a gap in care? Well, it's because we're getting the data to the providers up front. We're getting at a time frame that provider can actually influence the care that I get, not 30, 60 days, 90 days after the fact that the gap in care has happened, but before that gap in care has happened, right? That's one of the values. So again, those three things. Make sure you're picking the right investors, stick to your knitting, but also don't undervalue the scope of the value that you are providing to customers.
That's great. Thank you, Jason. Harsh.
How do you follow up a moment like that? So I actually 100% agree with Jason. I think finding the right investor fit profile is super important, you know, and the components that are the investor for the right stage you're at, the right industry you're at, people who understand your sales cycles, people who understand, you know, if evidence is important in your domain, importance of evidence, and so on, and who are willing to invest in you, not just from a financial piece, but from really looking at playing the long game with you for the next 5 to 10 years. So I think really finding those partners who they feel they really want to work with you, you really want to work with them. I think that's super important when you're looking for the right investor, because this is a partnership. You're bringing on another team member into your team and trusting your company with that and giving them a stake and say in what they're saying. So I think that, to me, that's number one. And number two, I think, is continuing to, putting the market conditions aside, continuing to really look at how you can build the best possible business in terms of value to your end users, value to the people who are paying you, value to all the stakeholders, and also doing it in a way that's cost effective and cost efficient, and truly does bring savings in the system. So I think really focusing on getting your infrastructure to measure that and improve that continuously, I think is independent market conditions everyone should be doing in our company, and doing it as early as you possibly can. So to me, like, those are the two things that I would encourage every entrepreneur who's fundraising now, which is, don't forget you're still building a business, but then find the right partners to bring on board to take it to the next level as well.
That's great. Nate.
Yeah, I would emphasize what Harsh said. The right investors are critical, especially when times get tough. You know, you want folks that understand your business and can add value to the business. So not all capital is created equally. And I know it's hard to be disciplined in a time when we see the charts that Megan and Rock put together when the environment looks like that. But to the extent you can, make sure that you are aligned with your investors, that they truly are part of the executive team when it comes to how the company is being driven. So that selection choice, I think, is critical. And then second, I would say be realistic. You know, it's really hard for us as founders to be realistic with anything, right? Growth projections, you know, how big we're going to be next year, how many markets we're going to be in. But when you can't quite see the end of the tunnel, you should really take the next few steps carefully and think about, you know, what are you doing truly that's within your wheelhouse, your niche, that's adding value. What is your burn going to look like? What do you really need today that you can, that you can't put off till tomorrow? And kind of presenting that story so that you're not overpromising. The worst thing I think you can do in this sort of environment is overpromise and underdeliver. And I think, it's been talked about how some of the companies accidentally got into that situation just because of the frothy markets, but to the extent you can avoid it, I think that's going to be key for the next 12 to 18 months.
Sounds great. Megan.
Yeah, so such thoughtful comments. I was just thinking what I can add to that. One thing from our experience at Rock Health as investors is we haven't seen deal flow slow down. So we've seen funding slow down, but not the kind of number of companies that we're talking to, we're getting pitched by. So I think that's important. And just to give some context on what I mean by those numbers, before the pandemic, we were seeing probably 600 to 700 companies a year in our deal flow. Again, we're seed Series A investors. Since 2020, it's been over 1,000 a year, and we are still on pace for that. So there are still a lot of companies building and a lot of companies seeking capital. So I think, like before, differentiation is hugely important. We've talked about some of the ways to differentiate. I think another one, and this kind of is to a point that Nate made, where you really have to show deep understanding of your customer, show that product market fit. Just to anecdotally share something, I was chatting with an academic medical center the other day. They were being really blunt that right now, they are probably the biggest like fee for service organization in the country. And having entrepreneurs and innovators that understand the context of who they're selling into, that just because you sell to providers doesn't mean that the entire provider market is your market. So Nate said, be realistic. I think be realistic about who you can go after. Yes, of course, maybe everyone one day is going to ultimately transition to a value-based care environment, but that is not the way that a lot of health systems are operating right now, especially, and it's not going to be what they're thinking about, especially with these really thin margins. And so being really cognizant of your business model, where it works, where it doesn't work, who you're going to approach, and conveying that in your conversations with investors, and conveying that market knowledge, I think is going to be increasingly important.
Hey,
Great.
Kamal, let me just turn back to you. I mean, you are a clinician, an innovator, a business leader, consultant. How would you answer your own question there?
Yeah, I mean, I was going to actually just say I loved the way Harsh said it in the beginning, which is sort of focus on fundamentals, right? Your job is to really become a great business, address a real need, and solve for a real problem that is a pain point that everyone's feeling. I think that is something that we find a lot of times isn't necessarily out of bad intention, but it is just out of maybe a lack of context, that companies pick a problem to focus on that does get affected by some of these sort of changes in environment, right? But if you pick a problem that's really critical, that is really fundamental to your end customer, then none of these things will really matter as long as you're adding value and you're creating value by doing that, by having that relationship and by offering a product. So if a company is truly adding value and is truly addressing a core problem and the fundamentals are strong and you're a good business, I don't see why they should have any problems. And those are conversations we're having on a daily basis with our clients, and trying to make sure that with every conversation, they're pivoting closer and closer to that sort of product market fit that's really going to be the basis for your success, and make sure their fundamentals are strong. So, but I think, unfortunately, there's no easy answer. and that is the hard work that I think is ahead for a lot of us. With that, I'd love to thank all of you for being part of this panel. This was really amazing insights. I really loved and really appreciate everyone being very open and honest and vulnerable with the way you guys have answered it. No one gave out the silver bullet, and I'm glad we couldn't, because I don't think there is one. But hopefully everyone in the audience learned a lot today, and I think all of us are open to receiving comments, feedback, questions. If anyone in the audience would like to sort of get in touch, and if you can't find how to find us, just let me know. I'm Kamal at Decimal.health. and I'll make sure that I triage it to the right people. Thank you again for attending to the audience, and thank you again for all the panelists to spare your time and be here with us today. Really appreciate it.
Thank you.
Thanks
Thank
so
you.
much.
All right, take care.
Cheers.